Something dangerous has just shaken the global economy in 2025, and surprisingly, it did not start in the United States or Europe. The epicenter of this upheaval is Japan. A quiet but profound shift inside the world's second-largest government bond market has suddenly turned into a global warning signal. Traders, governments, and central banks worldwide are now watching Japan with intense scrutiny, because the country that spent decades carefully maintaining financial stability has just triggered an alarm so serious that investors everywhere are sitting up straight. Japan's government bond market, totaling approximately $12 trillion, was long considered one of the safest and most reliable pillars of global finance. For decades, investors viewed it as an anchor of predictability in an often turbulent financial world. Yields on Japanese government bonds remained near zero for nearly an entire generation, and investors from domestic banks to international institutions treated these securities as virtually risk-free. But that perception is now shifting dramatically. Yields have surged, long-standing buyers are pulling back, and the central bank's traditional support mechanisms are weakening. The quiet, stable system that underpinned global markets is showing stress, and the world is finally recognizing a truth. Experts have whispered for years, when Japan shakes, the world trembles. What is happening in Japan is not contained within its borders, it has immediate and profound global consequences. The ripple effects touch the value of currencies, the cost of borrowing, the stability of pension funds, and the integrity of financial markets worldwide. Countries that rely on foreign capital are exposed to sudden shifts. Companies that depend on low-cost debt face rising expenses, and ordinary citizens may see their savings and investments affected by this unprecedented market turbulence. In short, Japan's financial recalibration affects virtually every corner of the global economy. This video will explore the factors that pushed Japan's bond market to this breaking point, and why global investors are treating this as more than a local problem. You will discover how a shift in Japanese yields can ripple across continents, shaking stock markets on the other side of the world, forcing governments to rethink their debt strategies, and potentially triggering a reversal of capital flows that have supported global economies for decades. Beneath the surface of these market movements, quiet forces are at work that few commentators fully examine. The retreat of major Japanese insurers, the slowdown of domestic banks and investors, and hidden stress building inside the country's massive debt structure all contribute to the pressure now felt internationally. At the same time, a single policy signal from the Bank of Japan has already caused one of the fastest reactions in global bond markets since the last major financial crisis, demonstrating the extraordinary influence Japan still wields over global liquidity and investor confidence. Japan carries one of the highest debt levels on the planet, far above what most developed economies would consider safe. Its government debt has grown relentlessly over decades as the country sought to support an aging population, slow economic growth, and recurring stimulus programs. Yet despite the size of this debt, Japan managed to maintain stability because of one critical factor: historically low interest rates. These near-zero rates kept borrowing costs manageable, allowing the government to issue massive amounts of bonds without triggering a financial crisis. Strong domestic demand also played a vital role. Japanese banks, insurers, and pension funds consistently bought government bonds, providing a steady and reliable flow of capital that prevented sharp fluctuations in yields. The central bank reinforced this stability through bond purchases, acting as the ultimate backstop whenever markets threatened to become unstable. This combination of low rates, domestic demand, and central bank support created decades of financial calm, where Japan's enormous debt appeared manageable and the market could rely on predictable behavior. This stability also fueled a global financial strategy known as the carry trade. Investors around the world borrowed yen at these historically low rates and invested the proceeds in higher-yielding assets abroad, from emerging market debt to U.S. and European equities. The inflow of Japanese capital stabilized foreign markets, strengthened global liquidity, and became a quiet backbone of international finance. For years, this cycle of borrowing in yen and investing elsewhere functioned as a reliable engine for the world economy, entirely dependent on the steady predictability of Japan's bond market. That predictability is now unraveling. Yields on Japanese government bonds are rising across both short and long-term maturities, a scenario almost unheard of in a country that kept rates near zero for decades. When yields rise, investors demand higher compensation for the same bonds, signaling increased perceived risk. Long-time domestic buyers such as insurers and pension funds are stepping back due to shrinking margins, higher domestic costs, and the risk of holding long-term assets that may lose value if rates continue climbing. Even banks, long seen as dependable purchasers, are becoming cautious. The combination of reduced domestic demand, increased issuance of new bonds, and a central bank stepping back from aggressive support is creating a squeeze in the market. The government is issuing more debt to fund reconstruction, stimulus programs, and ongoing social spending at the exact moment when demand is weakening, and the Bank of Japan is reducing purchases. More bonds enter the market while fewer buyers are willing to absorb them, pushing yields even higher. This dynamic adds pressure on public finances and shakes confidence in a market that for decades appeared unbreakable. Japan is not only a major economy but also one of the largest global holders of international assets. For years, Japanese institutions invested abroad in bonds, stocks, real estate, and infrastructure, creating liquidity and stability in markets across the U.S., Europe, and emerging economies. If Japanese investors begin to repatriate capital in response to rising yields, the impact is immediate. Foreign bond prices may fall, equities can weaken, and governments relying on foreign investment face higher borrowing costs. The withdrawal of Japanese capital can ripple through global financial centers within hours, creating uncertainty and volatility worldwide. Emerging markets are particularly exposed. Many benefited from Japanese capital inflows in times of stability but now face potential sharp outflows. Capital returning to Japan strengthens the yen, weakens local currencies, raises borrowing costs, and increases market volatility. Governments may raise domestic rates to defend their currencies, further slowing growth. Stock markets react swiftly to signs of capital flight, often triggering cycles of instability that are difficult to control. This is not just a Japanese problem, it is a global warning. For decades, Japan's bond market acted as a reliable anchor. Its stability allowed investors worldwide. If you care about the stability of the global economy, the movement of currencies, or the security of your own financial future, this is a story you cannot afford to miss. Welcome to our channel, where we break down the most significant economic shocks shaping our world today. For more in-depth, clear, and powerful explanations like this, make sure to subscribe and support our work. Japan carries one of the highest levels of government debt on the planet, far above what most developed economies would consider safe. Its debt has grown steadily over decades, driven by the need to support an aging population, stimulate slow economic growth, and fund repeated stimulus programs. In most countries, a debt pile this large would cause panic, but in Japan it became almost routine. For decades, investors trusted that Japan could manage it, and they had one crucial reason to believe so: extremely low interest rates. These low rates kept borrowing costs minimal. The government could issue massive amounts of bonds without facing crippling interest payments. At the same time, domestic demand for bonds remained strong. Japanese banks, pension funds, and insurance companies bought these bonds repeatedly, seeing them as stable, reliable, and predictable. The Bank of Japan further supported the market, keeping yields under control and preventing sudden spikes. As long as interest rates stayed near zero, Japan's enormous debt seemed manageable. This environment also enabled one of the most powerful financial strategies in global markets: the carry trade. Investors worldwide borrowed money in yen at these historically low rates and then invested it in countries offering higher returns. This injected huge amounts of Japanese capital into global markets, strengthening foreign bonds, supporting emerging economies, and keeping international liquidity flowing. For years, the carry trade was considered one of the most reliable engines of global finance, built entirely on Japan's low-rate system and steady bond market. Recently, however, that stability has begun to shift. Yields on Japanese government bonds have surged across both short-term and long-term maturities, a highly unusual development for a country that kept rates near zero for decades. Rising yields mean investors are demanding higher returns to hold Japanese debt, signaling growing concern. Traders who once regarded Japanese bonds as boring and predictable are now watching them with unease. Sudden movements in this market are rare, and when they occur, they often indicate deeper issues. At the same time, domestic demand for long-term bonds has declined sharply. The very insurers and pension funds that once purchased these bonds in huge volumes are stepping back, creating new pressures in a market that had been seen as virtually unshakable. This combination of rising yields, declining domestic demand, and a shift in investor behavior marks a turning point not just for Japan, but for the global financial system. Understanding this story is critical because the consequences ripple far beyond Tokyo, affecting currencies, global capital flows, and borrowing costs around the world. If you care about the stability of the global economy, the direction of currencies, or the future of your own financial security, this is a story you cannot skip. Welcome to our channel, where we break down the biggest economic shocks shaping our world. For more in-depth, clear, and powerful explanations like this, make sure to subscribe and support our work. Something dangerous has shaken the global economy in 2025, and surprisingly, it did not start in the United States or Europe. The epicenter of this upheaval is Japan. A quiet but profound shift inside the world's second-largest government bond market has suddenly turned into a global warning signal. Traders, governments, and central banks worldwide are now watching Japan closely because the country that spent decades maintaining financial stability has just triggered an alarm so serious that investors everywhere are sitting up straight. Japan carries one of the highest debt levels on the planet, far above what most developed economies consider safe. Its government debt has grown for years as the country tried to support an aging population, slow economic growth, and repeated stimulus programs. This huge debt pile might have caused panic anywhere else, but in Japan, it became normal. For decades, investors believed Japan could handle it without trouble because the country had one major advantage: extremely low interest rates. Those low rates kept borrowing cheap, allowing the government to issue massive amounts of bonds without facing crippling interest costs. At the same time, there was always strong domestic demand. Japanese banks, pension funds, and insurers bought these bonds repeatedly, seeing them as stable and predictable. The central bank supported the market as well, keeping yields controlled and preventing sudden spikes. As long as rates stayed near zero, Japan's debt looked manageable, even though the numbers were enormous. This environment also opened the door to a powerful global strategy known as the carry trade. Investors worldwide borrowed money in yen, where interest costs were extremely low, and invested that money in countries offering higher returns. This brought massive Japanese capital into global markets, strengthening foreign bonds, lifting emerging economies, and keeping international liquidity flowing. For years, the carry trade was viewed as one of the most reliable financial engines in the world, entirely dependent on Japan's low-rate system and predictable bond market. Recently, yields on Japanese government bonds have surged across both short-term and long-term maturities. This shift is unusual for a country that kept rates near zero for decades. Rising yields mean investors now demand higher returns to hold Japan's debt, signaling concern. Traders who once treated Japanese bonds as boring and predictable are watching with tension because sudden movements in this market are rare and often indicate deeper issues. At the same time, demand for long-term bonds has fallen sharply. The same insurers and pension funds that once bought these bonds in huge volumes are now stepping back. These institutions are facing their own pressures, including higher domestic costs, shrinking profit margins, and the risk of locking money into long-term assets that may lose value if yields keep climbing. Even local banks, long considered reliable buyers, are becoming more cautious. This pullback leaves a noticeable gap in the market, forcing the government to rely more heavily on new buyers who may demand even higher returns. Adding to the pressure, the Bank of Japan is reducing its bond purchases. For years, the central bank acted as the ultimate buyer, absorbing vast amounts of government debt to keep yields stable. Now, with inflation rising and policy shifting, the bank is stepping back. Without this critical backstop, the market is exposed to real price discovery, and investors are reacting quickly. Every auction is more uncertain, and each policy announcement carries heightened significance. Meanwhile, the government continues issuing more debt to fund massive spending programs, reconstruction plans, and new stimulus efforts. The supply of bonds rises exactly as demand weakens and central bank support fades, creating a squeeze in the market. More bonds enter the system while fewer stable buyers are willing to absorb them. As this gap widens, yields rise further, adding pressure on public finances and shaking confidence in a market that once seemed unbreakable. Japan is not just a major economy, it is also one of the world's largest holders of global assets. For decades, Japanese investors, including pension funds, insurers, and corporations, have invested heavily abroad in bonds, stocks, real estate, and infrastructure. This constant flow of capital has acted as a silent backbone of global liquidity, supporting markets and governments far beyond Japan's borders. Because of this deep global presence, even a small shift in Japan's financial behavior can create noticeable ripples worldwide. If Japanese investors begin repatriating capital, the impact is immediate. Demand for foreign bonds and equities weakens, prices fall, and yields rise. Governments relying on foreign investors to finance debt suddenly face higher borrowing costs, and companies depending on international investment may see stock values decline. In this way, a movement that starts inside Japan's bond market can reach global financial centers within hours, spreading uncertainty across continents. Another pressure point is the potential unwinding of the carry trade. For years, investors borrowed in yen at extremely low rates and shifted those funds overseas to chase higher returns. If Japanese yields continue to rise, this financial strategy could reverse, prompting massive capital flows back to Japan, strengthening the yen, weakening foreign currencies, and creating volatility in emerging markets and other international assets. This is not just a Japanese problem, it is a global warning. For decades, Japan's bond market acted as a reliable anchor, allowing investors worldwide to take risks elsewhere, knowing that Japan offered a safe harbor. With that anchor now shifting, global finance faces profound uncertainty. Investors may rethink risk allocation, central banks must prepare for secondary effects, and governments around the world may need to adjust debt strategies. In short, the Japanese bond market shock of 2025 is a critical turning point for global finance. It demonstrates how a single country, through its domestic decisions and financial systems, can influence the stability of markets worldwide. Understanding these dynamics is essential not only for investors but for anyone whose financial life, whether corporate, governmental, or personal, is connected to global capital flows. If conditions in Japan change, or if yields rise sharply, the global financial consequences can be immediate and severe. The carry trade, a strategy that has fueled global investment for decades, becomes risky under these circumstances. Investors may rush to close their positions, reverse their currency trades, and unwind their overseas investments. Such a reversal puts emerging markets at particular risk. These economies often thrive on capital inflows during stable times but can suffer dramatic outflows when global financial conditions tighten. As funds move back toward Japan, local currencies weaken, borrowing costs rise, and financial markets become far more volatile, reflecting sudden shifts in sentiment and capital allocation. Inside Japan, the story is no less concerning. Rising yields translate directly into higher interest costs for the government. Japan already carries one of the largest debt burdens in modern history, and even modest increases in interest rates produce enormous additional expenses. As investors demand greater compensation for risk, upcoming debt auctions come under intense pressure, and questions about Japan's fiscal sustainability grow louder. Each spike in yields represents a recalibration of perceived risk, sending signals not just to domestic actors but to international investors as well. When Japan's bond market quivers, the tremors are felt around the world. The volatility extends into global stock and bond markets almost immediately. Stock indices may experience sudden declines as investors reassess their exposure to risk. Bond markets elsewhere can swing unpredictably as traders attempt to interpret whether the movement in Japan signals deeper systemic troubles or is a temporary dislocation. Currency markets can also react violently, with the yen either strengthening or weakening dramatically depending on investor behavior and anticipated policy responses. Such rapid shifts amplify uncertainty, complicating financial planning for governments, corporations, and individual investors alike. The impact on borrowing costs is global. Japan represents one of the largest and most influential government bond markets in the world. When yields rise there, it tends to push global risk-free rates higher. This increases the cost for other nations to issue new debt, raises interest charges for companies dependent on loans, and can translate into higher mortgage and consumer borrowing costs. The ripple effects can slow economic activity, stressing financial systems already accustomed to prolonged periods of cheap money. The interconnected nature of global finance ensures that changes in Japan are not isolated. They touch everything from corporate balance sheets to everyday household finances. Emerging markets, in particular, face heightened vulnerability during such times. Many of these countries expanded with the support of foreign capital, including substantial Japanese investment. If this capital begins to return home, local currencies weaken, imports become more expensive, and inflation pressures rise. Governments may feel compelled to raise interest rates to defend their currencies, further slowing domestic growth. Stock markets in these nations often react immediately to signs of capital flight, creating cycles of instability that are difficult to manage or contain. In many cases, what begins as a shift in Japanese yields can trigger a cascade of financial disruptions half a world away. The unfolding events in Japan are not just about national debt, they are a lens through which the fragility of the global financial system can be observed. The delicate balance that has existed for decades, where Japan's low-yield bonds offered stability, now shows signs of cracking. Investors, both domestic and international, are forced to reconsider risk allocation strategies. Central banks must evaluate the secondary effects of rising Japanese yields on global monetary conditions, while governments adjust debt strategies to account for sudden changes in borrowing costs. The dynamics are complex, and every move has the potential to create far-reaching consequences. Moreover, the psychological impact on global markets should not be underestimated. Investors have long treated Japanese bonds as a safe haven. When that perception shifts, even slightly, it triggers reassessments across multiple asset classes, from equities to corporate bonds to currencies. Market confidence is fragile. Once shaken, it can lead to rapid adjustments in capital flows, often before any fundamental economic deterioration has occurred. These reactions underscore the interconnected nature of financial systems in 2025, where a policy change or market movement in one country can instantly influence markets around the world. In summary, rising Japanese yields represent a pivotal moment for global finance. The unwinding of the carry trade, the repatriation of Japanese capital, the upward pressure on global interest rates, and the vulnerability of emerging markets all converge to create a volatile, uncertain environment. The shockwaves from Japan's bond market do not stay confined, they ripple outward, affecting currencies, borrowing costs, and investor behavior globally. Understanding these dynamics is crucial for anyone invested in the stability of the global economy, whether in government, corporate finance, or personal investments. As we continue, the next section will explore the broader macroeconomic consequences of Japan's financial adjustments. We will examine how major economies might respond, which sectors face the highest risk, and what early warning signs investors and policymakers should watch closely in the months ahead. Japan's bond market is no longer just a domestic story, it is a barometer of global financial health, and its movements may well define the trajectory of the world economy in 2025 and beyond. All of these dynamics feed into a broader, more consequential test of global financial stability. For decades, Japan's government bond market acted as a reliable anchor in times of uncertainty, a place where investors felt secure even amid worldwide market turbulence. That stability allowed international finance to operate with confidence, knowing that one of the largest bond markets would absorb shocks and provide predictability. But now, with yields rising and domestic demand waning, that anchor is showing cracks. A shift this significant could ripple across the global financial structure, prompting investors to reevaluate how they balance risk, forcing financial institutions to adjust strategies, and potentially altering the fundamental mechanics of debt markets, capital flows, and government financing strategies in the years ahead. Central to this unfolding scenario is the Bank of Japan, BOE. For decades, the BOJ acted as the silent stabilizer of Japan's bond market, intervening whenever yields drifted too high to maintain calm and predictability. Its purchases of government debt were a powerful backstop, ensuring that even in turbulent times, the market could rely on steady support. Now, with volatility rising, attention turns to whether the BOJ will step back in to stabilize yields. A return to large-scale bond purchases or adjustments to policy guidance could reassure investors and calm jittery markets. Even subtle shifts in the BOJ's tone are amplified globally, as markets continue to regard it as one of the most influential forces in international finance. Yet, any intervention must be carefully balanced. Rising inflation and mounting pressure to normalize monetary policy limit the central bank's flexibility, meaning any action carries both domestic and global implications. Meanwhile, Japan's government faces its own set of challenges. Rising yields make issuing new debt more expensive, while weaker demand complicates the financing of ongoing fiscal programs. Policymakers may need to reconsider the pace and scale of stimulus measures, as well as explore new revenue sources to manage growing fiscal pressures. Analysts warn that Japan could be approaching a crossroads where more direct measures to address its debt-to-GDP ratio become unavoidable. Yet demographic trends, an aging population coupled with slow economic growth, constrain the speed and scale of any adjustment. Implementing reforms or long-term fiscal strategies will require careful planning and political will, and the consequences of missteps could reverberate both domestically and globally. Global markets are closely watching how these developments unfold, particularly the potential spillover effects on other major economies. Bond markets in the United States and Europe are sensitive to shifts in yields elsewhere, as investors often compare returns across regions. When yields rise in a major market like Japan, it tends to put upward pressure on borrowing costs internationally, influencing government debt issuance, corporate financing, and mortgage rates. Emerging economies are especially vulnerable. Even modest increases in global interest rates can trigger capital outflows, currency depreciation, and heighten market volatility. Countries that depend heavily on foreign investment must prepare defensive measures, whether through interest rate adjustments, regulatory tools, or fiscal safeguards, to mitigate these risks. Another critical element under scrutiny is the future of the carry trade. For decades, global investors borrowed yen at ultra-low rates and deployed the funds across higher-yielding assets in multiple countries. This strategy provided liquidity to international markets, strengthened emerging economies, and acted as a stabilizing force in global finance. Rising Japanese yields now threaten to undermine this system. As borrowing in yen becomes more expensive, the carry trade loses profitability and increases in risk. Investors may unwind positions, pulling capital back toward Japan, which could trigger market turbulence both domestically and abroad. The potential reversal of this long-standing financial engine underscores how deeply interconnected the world economy has become with Japan's low interest rate environment. The cumulative effect of these pressures is creating a complex web of financial interdependencies. Every decision by the BOJ, every change in Japanese yields, and every response by domestic institutions reverberates internationally. Investors and policymakers are keenly aware that Japan's bond market is no longer a predictable safe haven. Instead, it has become a potential source of volatility with far-reaching consequences. Understanding these dynamics is critical not only for investors but also for governments, corporations, and anyone whose financial decisions are linked to global capital flows. In short, Japan's rising yields and evolving debt market are more than just a domestic concern, they are a global signal. The stability of international financial systems, the movement of capital across borders, and the broader health of economies around the world now hinge on how Japan navigates this delicate period. In the next segment, we will examine the potential policy responses, the likely reactions of international investors, and the scenarios that could define the trajectory of global finance in the coming months. The stakes have never been higher, and Japan's financial decisions in 2025 may well set the tone for years to come. The potential global consequences of Japan's bond market shift are immense. Investors worldwide may begin unwinding positions built on years of stability, strengthening the yen and pulling capital out of foreign markets. This reallocation of funds can ripple across multiple asset classes. Stock prices may decline, bond yields may spike, and currencies in regions that previously benefited from Japanese capital could weaken sharply. Entire sectors, such as emerging market bonds, infrastructure projects, or real estate, may feel the shock if substantial amounts of capital are repatriated to Japan. Markets that were once bolstered by the quiet reliability of Japanese investors may now face volatility the likes of which they have not seen in decades. Japan's current bond market turmoil is more than just a financial headline, it is a global alarm bell. For decades, Japan quietly acted as a stabilizing force for international finance, providing a predictable and low-risk environment through near-zero interest rates, consistent domestic demand, and a calm, orderly bond market. Now, those pillars are shifting. As yields rise, domestic demand from insurers, pension funds, and banks wanes, and the Bank of Japan steps back from aggressive intervention. Global markets are beginning to feel the strain. Capital flows are changing. Borrowing costs are rising, and the familiar predictability of global financial systems is being challenged. The speed of these changes is unprecedented. Modern financial markets have rarely experienced such a combination of factors: massive national debt, sharply rising yields, reduced central bank support, and global investors simultaneously re-evaluating long-held strategies, like the carry trade. The uncertainty surrounding these dynamics makes forecasting particularly difficult. No investor, policymaker, or analyst can say with confidence how far these ripples will travel or how deep their impact will go. The mechanisms that underpin global financial stability for decades, predictable bond yields, steady capital flows, and low borrowing costs, are all under stress, and the results are only beginning to manifest. This moment is a wake-up call for markets that may have taken Japan's stability for granted. For generations, international investors relied on the calm predictability of Japanese bonds to anchor their risk assessments and stabilize their portfolios. That reliability allowed capital to flow smoothly across continents, funding growth and supporting financial systems far beyond Japan's borders. The erosion of this stability is a clear signal that the assumptions underpinning global finance need re-evaluation. Suddenly, markets that felt secure are exposed to uncertainty, with rising yields in Japan acting as the first domino in a potential chain reaction. The implications for policy and planning are vast. Governments dependent on foreign capital may need to rethink debt strategies. Central banks might have to adjust monetary policies in response to new risk assessments, and corporations must consider the increased cost of borrowing as rates rise internationally. Emerging markets are particularly exposed, as capital outflows from Japan can weaken local currencies, increase borrowing costs, and create volatility in equity and debt markets. Countries that previously thrived on predictable Japanese investment flows could see sudden reversals, forcing rapid adjustments in economic planning and financial risk management. Even domestic Japan is facing significant challenges. Rising yields mean higher interest costs for government borrowing, potentially impacting the nation's ability to fund essential programs. Pension funds, insurers, and banks face reduced margins and the possibility of losses on long-term holdings, prompting more cautious investment strategies. The BOJ's role has become critical. Its next moves could either stabilize the market or, if miscalculated, exacerbate the volatility. Policy decisions made in Tokyo now have immediate and significant implications for global finance, as investors worldwide watch closely for signals that may alter the flow of capital. What makes this period particularly fraught is the sheer scale of uncertainty. Markets have never seen a situation where Japan's massive debt, the retreat of domestic buyers, reduced central bank intervention, and global investor reassessment converge so sharply. Each of these forces alone could influence markets, but together, they create a complex, interrelated system that has no modern precedent. The trajectory of yields, capital flows, and investor confidence is unpredictable, making this a pivotal moment for global financial stability. One thing is certain: the era in which Japan could quietly underpin global markets with stability is over. The calm that characterized its bond market has been replaced by questions and uncertainty, and the answers to these questions could reshape global debt markets for years to come. Investors, policymakers, and individuals alike must pay attention, as the repercussions extend well beyond Tokyo or even Asia. They are truly global in scale. If you found this breakdown valuable and want to stay informed about major shifts shaping the global economy, make sure to like this video and subscribe to our channel. Supporting our work ensures that you receive clear, in-depth, and powerful explanations of the stories that are driving change in financial markets worldwide.